Hello everyone. I am Dr. Ambuli, Associate Professor, SRM Institute of Science and Technology, Ramapuram. In this video, we are going to discuss about the activity ratio. So already I have posted two videos with respect to ratio. One is introduction about the ratio, and another one I have posted about the solvency ratio or balance sheet ratio. The next ratio we are going to discuss today is activity ratio. So first we'll see what is activity ratio, then what are the different types of activity ratio we will compute, and then we'll see about the how to compute the activity ratio or turnover ratio. So activity ratio is otherwise called as turnover ratio. So this ratio we are calculated based on the turnover. So here, in order to calculate this ratio, one of the variable we are going to consider as turnover is nothing but the sales or cost of sales. Okay, on the basis we are going to calculate the ratio. So here in the turnover ratio is otherwise called as efficiency ratio, or we can call it as activity ratio. Why we are called as efficiency ratio? Because in order to find out our efficiency of our business, so we have to identify with the help of the turnover. The other name for turnover is nothing but the sales, or we can call it as a revenue generated for the business. So the revenue can be generated only in the form of sales only. So with the help of sales or related to sales, we are keeping one variable, and another variable we are going to take from the other aspect of our financial statement. So in the case of ratio means, already I discussed, ratio means finding relationship between two variables. With respect to financial ratio, we are going to find a relationship between two financial variables. Okay, so here in the turnover ratio, one financial variable is nothing but the turnover, or we can call it sales or related to sales. The another variable we are going to consider with respect to the particular ratio, it may be the variable may be from trading account or P&L account or balance sheet. So on that basis we are going to calculate this ratio. That's why it is called as turnover ratio or efficiency ratio or activity ratio. So here this ratio, the main purpose is to measure the efficiency of investment. So when you are doing a business, definitely we are invest some amount at the initial during the period, so in order to run our business. So in such a case, whether our investment is efficient or not, in order to identify that, so we are going to find out the variable is nothing but the revenue. The revenue can be generated by the business in the form of sales. Okay, so one variable is nothing but the sales we are going to use in this ratio. That's why based on the sales only, the ratio we are going to calculate. That's why it is, this ratio is able to measure the business efficiency. Okay, so there are different ratio under turnover ratio. The following are the ratios we are going to calculate. Number one will be fixed asset turnover ratio. Number two will be capital turnover ratio. Number three, working capital turnover ratio. Number four, debtor turnover ratio. Number five, creditor turnover ratio. Number six, stock turnover ratio. Okay, these are the basic variable we are going to use with the help of your sales, and we are going to compute the ratio. Okay, so here whenever the turnover ratio gives a result as I, so in this case that particular business is in good position. So here, so based on this ratio, most probably it will be expressed in the form of proportion, that is in times. Okay, so here first we will see about the fixed asset turnover ratio. Already I said, whenever you are calculating a turnover ratio, one variable will be sales or related to sales, another variable will be the respective ratio which we are going to calculate. So here we are going to calculate fixed asset turnover ratio. So one variable is fixed asset, another variable is nothing but a turnover. Here we are going to consider as a cost of sales or sales. So here, yeah, based on the cost of sales and fixed asset, we are finding a relationship. Based on this will give us about the how we are going to utilize the permanent asset in the business. So this also is one way we are going to identify the efficiency of the business, because the assets and liabilities, income and expenses, all these are considered when you are calculating our efficiency of the business. Okay, so here in order to calculate the fixed asset turnover ratio, already I said the formula will be net sales or cost of sales divided by net fixed asset. So here the net sales, what is the term net sales? Net sales refers to sales minus sales minus sales return or return inward. So from the sales you have, if a sales return or return inward is in the firm, those value you have to subtract it, and the balance only we can call the net sales. Okay, then another, or if the net, if you can use cost of sales also. So in this case, the cost of sales you have to find out by using a formula. There are two formulas available in order to compute your cost of sales. The first formula is nothing but cost of sales equal to net sales minus gross profit. Whenever the data is not available to compute a cost of sales, in such a case, we are going to use the next formula in order to determine the cost of sales. So the next formula is nothing but opening stock plus net purchase plus all direct expenses minus closing stock. By using this formula, you can find out the cost of sales. So either you can use net sales or cost of sales in order to taking as a one variable as a for a turnover ratio in the numerator, and another variable will be the respective ratio which you are going to compute. So here fixed asset, so I am going to use net fixed asset. What is the term net fixed asset? Net fixed asset is nothing but the total of permanent asset minus depreciation. So whenever this fixed asset ratio gives a higher ratio, it says about it conveys that the particular business, they are using their asset in a better way, utilizing the asset in a better way or optimized way. The next one is the working capital turnover ratio. So already I said, according to the ratio, we have to one variable be sales or cost of sales. Another variable will be the respective which ratio you are going to calculate, that we are going to use as a denominator. So here working capital turnover ratio, we are going to determine the operating efficiency of the particular business, how the business is doing the utilizing the current asset in the regular functioning of the business. Okay, so in this case, in order to determine the working capital turnover ratio, the formula is nothing but net sales or cost of sales divided by net working capital. So already I explained about how to determine the cost of sales or net sales. The next one, the denominator only we have to discuss now. That is nothing but net working capital. So what is the term net working capital? Net working capital refers to the current asset minus current liability, or excess of current asset over current liability. What is the term current asset? Current asset is nothing but the temporary asset which are easily converted to cash whenever the business required. Those assets only we can call as a current asset. I explained these two information, current asset and current liability, when we are discussing about the solvency ratio. Then what is the term current liability? So those liability the business has to pay within a year, within a shorter duration, those liability only we can call as a current liability. So difference between the current asset and current liability only we can call as a working capital, or we can call as operating capital. So how the operating capital meet out our efficiency of the business, that we are going to find out with help of the working capital turnover ratio. So the formula is cost of sales divided by net working capital. Whenever this ratio gives the result as I, it says about that, so the particular business utilizing the current asset optimally, and also they are paying off the current liability in a right time. That's why the turnover will be the turnover of the business will be increased. Suppose the reverse means, then it reverse one, so that it says that it conveys that, so many the particular business having more debtors and more bill receivable, that is they are entered into more credit sales. So credit sales, and they are lend money to many, they are not return back the money immediately. So most of the money are ideally in debtors and bill receivable. So that you have to take care, you have to some extent you have to reduce those two assets in order to increase the operating efficiency of the business. The next ratio we are going to calculate is nothing but debtor turnover ratio. So debtor turnover ratio is also called as account receivable ratio. It says about how the receivables are how quickly the credit sales are converted into cash. That we are going to identify the efficiency of the credit sales converted into cash, that we are going to identify with the help of debtor turnover ratio. So this ratio can be calculated by using the two variable. One is turnover. Turnover here we are going to consider as credit sale only. So with help of credit sale only we can able to calculate this debtor turnover ratio. Okay, so the numerator will be a net credit sales divided by average account receivable. So what is net credit sale? So net credit sales nothing but the total sales. From the total sales we are subtracting the cash sales and the sales return. The balance what we are left out, that only we can call as a net credit sales, that divided by average debtors or average account receivable. So average debtors or average account receivable we can calculate by using the formula, that is average debtors and average bills receivable. What is the term average debtors? Opening debtors of the particular business, along with that you have to add closing debtors of the business, divided by 2 only will get an average debtor. Similarly, average bill receivable is nothing but opening bill receivable plus closing bill receivable divided by 2. That gives your average account receivable. Okay, so here in order to suppose in a question they are given only opening or closing debtor only is given. Similarly, bill receivable opening or closing, which one is given in the such a case, that you can take it as average. Don't divide it by 2. Whenever opening and closing is given in your question, in such a case only you add it and divide it by 2. Otherwise, which one is given, that itself you can take it as an average itself. Okay. So I'll explain the debtor turnover ratio with help of this formula, with help of this example. See here, see the question. A firm has a total sales of rupees 5 lakh, out of which the credit sales rupees 2,50,000. The opening balance of account receivable is 2 lakh and closing balance at the end of the financial is rupees 1 lakh. Calculate debtor turnover ratio. So already I said debtor turnover ratio you can be calculated by using a formula, is nothing but credit sales divided by average account receivable. Here in this question they are not given the credit sales directly, they are given directly. Suppose if it is not given also you can calculate. So here is given, they are given total sales 5 lakh and credit sales is 2 lakh. So I'm going to substitute the credit sales value as 2,50,000. Then average account receivable I have to calculate. Here the opening balance of bill receivable is given and closing balance of bill receivable is given. So they are not given about the details about the debtor. Okay, so now what I have to do in order to find out the average debtor or average bill receivable, adding whenever the opening and closing is given, then add it and divided by 2. So here opening and closing is given in this question, so I am going to add it. Opening is 2 lakh and closing 1 lakh. So total together we get 3 lakh, divided by 2 we'll get 1,50,000. So that 1,50,000 only we can call as average bill receivable or average account receivable or average debtor. So that we are using in a formula, 2,50,000 divided by 1,50,000, the net result we are getting as 1.67 times. Then with respect with the connection with the average the debtor turnover ratio, we can find out another one more formula, that is nothing but debtor velocity or average collection period. So what is the term debtor velocity or average collection period or debt collection period? So this ratio represents that how much time it takes to recover our credit sales in our business, to identify how long. So when you are going to take back this credit sales, converting a credit sales into cash, that we are going to identify with the help of average collection period. So average collection period you can compute either in days or month. So in order to compute this, we are going to use the formula is nothing but days or month in a year divided by debtor turnover ratio. Days in a year or months in a year divided by debtor turnover ratio. Okay, so yeah, how many days in a year? How many days in a year? So 365 days in a year divided by debtor turnover ratio. If we are going to calculate months, means how many months in a year? 12 months in a year. So 12 divided by debtor turnover ratio. Okay, so here debtor turnover ratio you can debt collection period you can calculate by using the days or month. So which one is convenient for you, that you can use it and you can calculate the debt collection period, average collection period. So here suppose you are using days, means 365 days or 360 days. If it's leap year you have to use 366 days divided by what is the debtor turnover ratio, that you have to use it and find out the average collection period. So see this example, a firm has a credit sales of 5 lakh and average account receivable is 1 lakh. Okay, calculate the average collection period. First I want, because in order to collect the average collection period, I am going to calculate by using the formula days or months in a year divided by debtor turnover ratio. So here in this example, just I calculate in days. So here days in a year divided by debtor turnover ratio. So days in a year, for the particular year you have to take 365 days. Okay, because they are not mentioned which year. So generally we are going to take 365 days divided by debtor turnover. Debtor turnover ratio is not given, you have to calculate. So first step you have to calculate what is debtor turnover ratio. So what is the formula for complete debtor turnover ratio? Credit sales divided by average debtor. So credit sales they are given 5 lakh divided by average account receivable 1 lakh. 5 lakh divided by 1 lakh will get 5 times. So here divided by 5 times will get 73 days. So whatever credit sales in the business, all those credit sales you are going to convert within 73 days. The next one we are going to discuss about the creditor turnover ratio. So what is creditor turnover ratio? So this ratio says about when you are going to make a payment to your credit purchase or from whoever you are lend money, whoever you are borrowed money. So this efficiency we are going to calculate with the help of the creditor turnover ratio. Okay, so this creditor turnover ratio speed up the payment or made to a state creditor, and also you are going to find a relationship between the with respect to creditor always says about the purchase, what is the credit purchase you have made from the supplier divided by average accounts payable, how much you are going to pay averagely to the supplier or creditor. So here this ratio you have to find out what is the term net purchase. Net purchase is nothing but from the total purchase you have to subtract the cash purchase and also purchase return. The balance only we can call as a net purchase. Net credit purchase divided by average accounts payable. Average accounts payable nothing but average creditor plus average bills payable. What is the term average creditor? Opening creditor plus closing creditor divided by 2. Opening bills payable plus closing bills payable divided by 2. This only gives your average added together, average creditor plus average bills payable only. It gives your average accounts payable. Okay. So related to this, we have to connection with it. We have to another one more formula is nothing but average payment period or creditor payment period. So this ratio states that what is the time period you are going to settle your all credit purchase, all credit to your business from your business. So here, in order to compute average payment period or creditor payment period, the formula is nothing but, so how many days it takes or how many months it takes to make a payment divided by creditor turnover ratio. Similar like a debt collection period, here the days always we can consider 365 days. If it's not a leap year, if it's leap year, 366 days, and you have to mention as a note. Then in the case of month, you have to mention 12 months in a year. So divided by creditor turnover ratio. Okay. The next we are going to discuss about the, we'll see the examples of creditor turnover ratio. Calculate the average age of creditors and creditor turnover ratio. Average age of creditors says about your payment period, average payment period or credit payment period. How long you are going to, how long means how many days or how many months you are going to make a settlement to whom you are borrowed. Okay, so first here they are given creditor closing, bills payable closing, total purchases, cash purchases, purchase rent, and days of a year. So first, in order to calculate the creditor turnover ratio, the formula is nothing but net credit purchase divided by average accounts payable. What is the net credit purchase? From the total purchase 3,38,000, I am subtracting the cash purchase 28,500 and the purchase return 9,500. These two we have to subtract from 3,38,000. The balance what we are getting is nothing but 3 lakh. That is nothing but your credit purchase. That's why I am substituting here. Average accounts payable is nothing but these creditors and bills payable. Here the creditors as well as bills payable, they are not given any opening. They are given only closing. So that itself I am taking as an average. So average creditors are given 54,200 and average bills payable they are given as 5,800. Together we are getting as together we added together only we are getting as 60,000. That itself is the average accounts payable. So 3 lakh divided by 60,000 we are getting 5 times. This says about our creditor turnover ratio. The next one we are going to find out what is the average age of creditor or average payment period or credit payment period. So here they asked to calculate in days. That's why they are given days. So days in a year divided by creditor turnover ratio. Days 365 days and creditor turnover ratio is 5 times. 365 divided by 5 is nothing but your 73 days. It takes you are going to settle all credit purchase or credit payment to suppliers or to whoever you are borrowed money. The next one we are going to calculate as stock turnover ratio. Stock turnover ratio says about how efficiency or your cash will be held in your stock. Okay, so in this case, because most of the cash are tied up with the stock, means your operating efficiency will not be good, because you have to run your business smoothly. In this case we need cash also, and also we need some stock for running our business. So which type of stock you have hold in your business, whether raw material or work in progress or a finished product or suppliers like that. So that you have to take into consideration. So in this case we are not to calculate stock turnover ratio. The formula for computing a stock turnover ratio is nothing but sales or cost of sales divided by average stock. Because the stock turnover is very very important, because in order to minimize to identify our efficiency of our business by neither keeping more stock in our business nor maintaining less stock, inadequate stock. Both will show that inadequate stock if you have, then you will not continue your business, your production will be stopped. For example, you have you need some amount of raw material to run to smooth run of your business for a week. Suppose we need only 10,000 quantity of raw material for a week. That is suppose if you have only 9,500 value of stock in your business, then your production will be stopped in between, because we have a shortage of 500 units of stock. Suppose you need only 10,000, if you have 11,000, your cash unnecessarily idle in your stock. So you have to find out what is your optimum stock. That's why we are calculating, because your investment always speaks about your turnover. So turnover can be identified with a turnover should be optimized, should be the stock will be optimized in order to give a better turnover or sales in your business. So that's why we are computing a stock turnover ratio. So sales or cost of sales divided by average stock. So already I explained what means term sales and what means term cost of sales. So average inventory is nothing but average stock or average inventory is nothing but opening stock plus closing stock divided by 2. Suppose in your question they are given either any one of the stock, either opening or closing is given, that itself we can take it as an average stock. If both is given, in this case only we have to add it and divide it by 2. Okay, so here just with help of this example I'll explain how to compute the stock turnover ratio and stock velocity. So along with this stock turnover ratio, we have another one more formula is nothing but stock velocity. That is how much, how long it takes your stock convert into cash. So that's why we are going to compute a stock velocity. So here first in order to compute a stock velocity, the formula is nothing but how long is always says about the period. So days or month in a year divided by stock turnover ratio. If it's days means we are going to use 365 days in a year. If it's month means we are going to use 12 months in a year divided by stock turnover ratio. So in this example, they asked to calculate stock turnover ratio and stock velocity. So stock turnover ratio you are going to compute by using a formula cost of sales divided by average stock. How to compute cost of sales? So cost of sales is nothing but sales minus net sales minus gross profit. Here in the question they are not given gross profit or sales. So we are not depend on the particular formula. We can use the next formula to compute your cost of sales. The next formula to compute cost of sales is nothing but opening stock plus net purchase plus all direct expenses minus closing stock. So here you see this question, the opening stock they are given 1 lakh rupees, net purchase they are given 75,000, then direct expense they are given 25,000 and closing stock they are given 50,000. So by using this way of value and I am going to compute by using the formula I am going to compute the cost of sale. Opening stock 1 lakh, net purchase, because here there is no purchase return. So whatever purchase given, that itself I am taking as a net purchase. Then direct expense they are given as direct wages. I am taking 25,000 minus closing stock 50,000. So 1 lakh plus 75,000 plus 25,000 minus 50,000, you are getting 1 lakh 50,000. This is nothing but your cost of sales. I am substituting here. Then average stock we have to compute. Average stock, how you compute? Whenever the opening and closing stock is given, add it and divide it by 2. So that's why I am doing opening stock 1 lakh and closing stock 50,000, both added together and divided by 2. 1 lakh plus 50,000, you are getting 1 lakh 50,000 divided by 2, 75,000. That I am substituting 75,000 here. From 1 lakh 50,000 divided by 75,000, we get 2 times. Then what is stock velocity? Stock velocity is nothing but days or month in a year divided by criteria stock turnover ratio. So here either you can use days or month. I solved this question by using month because of previous 2 example I used only days. That's why. So 12 months in a year divided by stock turnover ratio is 2. So 2 times divided by 2, I am getting 6 months to convert our stock into cash. Similar like that, we can calculate capital turnover ratio. So capital turnover ratio is nothing but cost of sales divided by capital. You are going to find out so how efficiency the capital will be in order to prove as a in the form of revenue is generated. So that's why we are going to use the capital turnover, cost of sales or sales divided by net capital. So by using that formula, you can find out the capital turnover ratio. So these are the ratios, basic ratios we are used for computing a turnover ratio. Thank you.